Hello. Welcome back to the International Economics course. So our 10th theme concerns financial globalization. So what do we mean by financial globalization? So far we have discussed the globalization from the point of view of trade in commodities and services. But then, of course, we can also think about from the factors of production side. So we can think of labor mobility and then also capital movements. So obviously, the international trade in financial assets such as stocks, loans, deposits, land ownership, and physical capital, it is much easier to trade in this type of assets than in commodities or labor. And this is, of course, closely related to the digitalization. So with the digital technologies and telecommunications technologies, international financial transactions have become very easy, fast, and cheap in this. So we don't really need any cross any physical frontiers to trade some stocks or exchange currencies, for example. And therefore, there's also this where globalization has really boomed over the past few decades is indeed in this kind of financial assets. So just as an example, I have here taken the growth of in the foreign exchange trading volume measured in billions of US dollars. Notice the scale in billions of US dollars. So, and notice also that these are daily figures. So just for sake of comparison, notice that yearly global GDP, so the GDP of the whole entire world is about 100 billion US dollars. So in the foreign exchange market, already in early 2001, there was already forex trade covered many times of the annual GDP of the world in a single day. So notice how this trading volume has still over the past 20 years increased every year. So obviously, it is natural that as the economy is growing, that also, of course, this kind of foreign exchange trading increases over time. But if it is the volume is so large that this it compares to the many times the yearly GDP in a single day, then obviously it tells us that that very large proportion of foreign exchange trading is just speculative trading. That is nothing to do with the transactions of, for example, exporting companies or multinationals, but it's just speculative trade. So notice that in this figure, it includes not only the spot market, so this is this kind of immediately occurring exchange of currency. There's also forward contracts, and then various types of currency swaps and forex swaps, and then there is options and other derivatives as well. So I don't go to the details of what is these kind of forward contracts or swaps mean, but this is also means that this market is more complicated. And of course, the large volume of speculative trade also can mean that in these exchange rates can be rather volatile, and that can have also effects on the real economy. So this kind of speculative trade, of course, by construction is just a zero-sum game. So it doesn't really necessarily have any intrinsic value. Of course, not all the speculation is bad, but if a large amount of assets are devoted to just speculative trading, then it can also then have some kind of adverse impacts on the real economy. So just as an illustration, let me plot here the exchange rate of euro relative to Norwegian crown, indicated by NOK. So this is the end of 2024 and 2025. So notice how volatile the exchange rate between a relatively small currency as Norwegian crown has been relative to euro, and in a relatively short amount of time of about 1 year, there have been so many kind of sudden ups and downs. And of course, for companies, for example, Norwegian exporters that export to Europe, then this kind of exchange rate volatility will then be an additional source of uncertainty that has some costs to the Norwegian exporters. Similarly, of course, for European companies and that have operations in Norway, this kind of exchange rate volatility implies some kind of costs. So in the next video lesson, then I will discuss the so-called Tobin tax that has been suggested as a remedy for this kind of volatility and speculative trade. See you then.